problem to the we have now the requirement prepare statement of financial position with supporting notes and computations. Now in chapter 2, the focus is statement of financial position. Here we are going to prepare the statement with supporting notes and assumptions given the following on December 31, 2020. We have the current assets of 3.1 million, other assets 5.9 million, current liabilities 1 million, long-term liabilities 1 million, and capital of 7 million. Cash including 200,000 invested in money market and restricted foreign deposit of 300,000. Land held for undetermined use, and we have accounts receivable less allowance of 50,000, inventories 600,000, and Socorro Corporation share capital at cost 300,000. Now the name of our company is Socorro Corporation. Now we are given the total current assets of 3,100,000. Then we have the total other assets including store supplies, building less allowance of 500,000, equipment less allowance of 250,000, financial asset at amortized cost 1 million, trademark 300,000, advances to officers, indefinite repayment, patent, and land. So we have now the total other assets. In the summary, we have 5.9 million this time. We have the total of 5.9 million. Now for the current liabilities of 1 million and the breakdown, accounts payable, notes payable due December 31, 2021, income tax payable and share premium of 250,000 with the total current liabilities as provided is 1 million. Then unearned leasehold income 5 years starting 2021 350,000, stock dividends payable 150,000, and serial bonds payable 100,000, maturing annually 500,000. So the total long-term liabilities as given in the summary of 1 million. Retained earnings 1.5 million, share capital 100 par 5 million, and retained earnings appropriated for plant expansion of 500,000. So the total capital as given above is 7 million. Now we have to prepare a statement of financial position. First, we begin with current assets. Now, we are providing with the notes as required. Prepare the notes and computations. So, cash and cash equivalents as provided in note number 1. Cash and cash equivalents, cash of 500,000 and money market placement of 200,000. Now stated, cash is given at 500, not 1 million, but this includes money market placement of 200,000 and restricted foreign deposit of 300,000. So the cash properly classified as current asset is only 500,000. And then we add the money market placement of 200,000, total of cash and cash equivalents as provided in note number 1 is 700,000. Now take note that we have excluded the restricted foreign deposit of 300,000. Next, we have trade accounts receivable as provided in note number 2. Trade accounts receivable, the accounts receivable of 750,000, that's the gross. We add back 50,000. So the allowance for doubtful accounts of 50,000, thus giving us the gross accounts receivable of 750,000. The net realizable value of the accounts receivable as provided in note number 2 is 700,000. Then followed by inventories of 600,000 included, and prepaid expenses of 50,000. So we have excluded the amount of land held for undetermined use of 500,000. It's not proper to include it among the current assets. So we have now the total current assets of 2,050,000. Now the prepaid expenses is the amount of the store supplies amounting to 50,000. Now, the non-current assets includes property, plant, and equipment. And we have now your note number 3. Note number 3, we have store supplies. Note number 4, property, plant, and equipment. The land amounting to 400,000, that's the carrying amount. Then the building of 3.5 million, adding back 500,000 to 3 million. Equipment is 1 million. So we have now the building at the carrying amount or book value of 3 million and equipment of 750,000. Now we have the land as given of 400,000. So the total of the carrying amount is 4,150,000. That's now the amount of property, plant, and equipment in note number 4. In note number 5, we have the long-term investment shown in note number 5. Long-term investment is the amount of the financial assets at amortized cost. So we have the amount of financial assets at amortized cost equal to 1 million. Then note number 6, investment property. Now land for undetermined use for 500,000 as included among the current assets. So we have land for undetermined use for note number 6. Note number 7 is intangible assets, and the intangible assets includes trademark. Okay, so trademark 300,000 and patent of 250,000. The total intangible assets of 550,000. And we have note number 8 for the other non-current assets, advances to officers for 150,000. Now, it's other assets. The fact that the repayment date is indefinite, so it's not current. And we have now the restricted foreign deposits originally included in cash. So the amount of 300,000. It's not cash because it's not a current asset because its use is restricted. So we include that among the other non-current assets. Now, with the assets to be added, we have now the current of 2,050,000. Then we add the non-current property, plant, and equipment with the corresponding note, long-term investment, investment property, intangible assets, and other non-current assets. So, the total of the non-current assets added to the current assets, total assets of 8,700,000. Next, we have the liabilities and equity as provided in note number 9. So we have now trade and other payables. Accounts payable of 500,000, notes payable of 100,000. It's proper to be classified as current because the maturity date is within 1 year. The date now is December 31, 2020, and the maturity date of this note is within 1 year. So we have current liability. Then we include income tax payable 150,000 and unearned leasehold income, the current portion. If you have your unearned leasehold income for 5 years, meaning it's 70,000 per year. So classified as current is the amount applicable to 1 year, and the remainder will be classified as part of the non-current portion. So the current liabilities now, the total of the trade and other payables, the total of the current liabilities amounting to 920,000. The trade and other payables as shown in note number 9. So that's for the amount of 820,000 current liabilities, and then we include serial bonds current, still current, serial bonds payable. The amount of the serial bonds payable is 500,000, but during the current year 100,000 is maturing. So we have the total current liabilities of 920,000. The non-current liabilities includes the serial bonds payable, the non-current portion, meaning it's 500,000 for the total, and then we deduct the currently maturing of 100,000. So there's a difference of 400,000. That's the remaining portion. Then for the unearned leasehold income, the original amount of uh, unearned leasehold income is for 350,000 minus the currently due portion, because we have the total of 350,000 unearned uh, serial or unearned leasehold income. 5 years starting 2021. So the portion that will be due beyond 1 year is 280,000. That's 70,000 per year times 4. While the first 70,000 is recognized as part of your currently due portion. We have note number 9. Okay? So we have included the 1 year currently maturing portion of 70,000. So the total liabilities, here we have the total of current 920,000 and the non-current portion of 680,000. Next, for the equity, we have the equity of share capital equal to note number 10. Okay. Note number 10, we have share capital issued of 5 million. And we have stock dividends payable given at 150,000. So the stock dividends payable included among the liabilities. However, this is part of your equity section. So 150,000. That's why our total equity is 5,150,000 for the share capital. For the reserves, we have note number 11, share premium 250,000. 250,000. And then we have retained earnings appropriations. For plant expansion, given is 500,000, and for treasury share equals 300,000. Now, where do we get the amount of treasury shares of 300,000? Since no amount is given among the stockholders' equity, you're only given retained earnings, share capital at par of 5 million, and we have retained earnings appropriated for plant expansion. So the amount of 500,000. Now, take note that we have your uh, total capital is given initially at 7 million. However, here we are going to include only the total of your equity for 1 million, or no, 7,100,000. So what happened? Share capital 5,150,000. Then we are given the reserves of 1,050,000. That's now your reserves. Now this corporation share capital at cost included among the assets. Current assets, Socorro Corporation share capital at cost of 300,000. This is actually treasury shares. So this is actually treasury shares, meaning the company reacquired its own shares. So supposed to be the debit is treasury stock and credit to cash, and then debit to unappropriated retained earnings and credit retained earnings appropriated for treasury stock. Now you will notice that the Socorro Corporation share capital is included at cost of 300,000, indicating that the company reacquired its own stock, and we call it treasury stock. We define treasury stock as the corporation's own stock reacquired either through purchase or donation. So it means that the corporation reacquired its own stock, and it debited Socorro Corporation share capital at cost upon reacquisition. The debit of 300,000 and credit to cash. Supposed to be the debit is treasury stock. And finally, record the appropriation by debiting the account retained earnings unappropriated and credit to retained earnings appropriated for treasury stock. Now, the total of the reserves is 1,050,000. It's 1,050,000. That includes the share premium included among the total current liabilities. Actually, share premium is part of your share capital, uh, part of the reserves, no? Part, I mean, of the shareholders' equity. So, part of the reserves share premium 250,000, retained earnings appropriated for plant expansion 500,000, and retained earnings appropriated for treasury stock of 300,000. So if we now go back to our shareholders equity, note number 10, share capital 5,150,000. Then we have the reserves in note number 11, 1,050,000. And we have now the retained earnings in note number 12. Retained earnings unappropriated initially given is 1,500,000, and then we deduct the appropriation for treasury share 300,000, so the adjusted balance is 1,200,000. Earlier, I mentioned that your entry upon reacquisition of the company's own stock is to debit, first, debit to treasury stock, credit cash. Second entry is to debit retained earnings or the unappropriated retained earnings for the amount of 300,000, and credit retained earnings appropriation for treasury share. So finally, it's deducted. So the adjusted balance of retained earnings only 1.2 million. Okay, so meaning we have prepared a properly classified statement of financial position. By the way, I did not answer problem 2-1 because I assigned that to you. So I will answer only more 2-3 and 2-4. Again, I assigned to you 2-5 up to 2-16. 2-5 up to 16. Okay, I will now continue with the problem 2-3. Here, the requirement is prepare in good form for a properly classified statement of financial position with appropriate notes. Okay, so we have now problem 2-3. We have to consider the solution with 8 notes. So we have this statement. In 2-3, we have now the current assets, cash. So the current assets cash, the amount is 400,000. Okay, so where did we get this? In paragraph number 3, the current assets include cash of 400,000, accounts receivable 700,000, less 50 for allowance, so we have the net amount of 700,000. Inventories 800,000, and prepaid expenses of 100,000. Now, included in here is we have financial asset at fair value for the amount of 100,000. So, 100,000 investment in securities. short term. That's why we have financial assets at fair value. Actually, this is a current investment in securities, and it is short term. 100,000. We have the trade accounts receivable. Initially is accounts receivable 750,000 minus the allowance of 50,000. So the balance of the accounts receivable is 700,000 as found in note number 1. Then we have the inventories in the amount of 800,000 given, and prepaid expenses given of 100,000. The total current assets of 2,100,000. Now, for the non-current assets, we have the property, plant, and equipment as found in note number 2. Property, plant, and equipment, land of 1,250,000. That's now the amount of your land as given. We have the tangible assets of 7,150,000, and we have the following included: building 5 million less accumulated depreciation of 1.6 million. So the carrying amount or the book value is 3.4 million. Then we have the equipment of 1.4 million less accumulated depreciation of 400,000, the book value of 1 million. So these are the amounts for building and equipment. Then we have the amount for land for future plant site as given is 1,500,000. Now it's part of property, plant, and equipment, and land of 1,250,000. So the tangible assets, actually the carrying amount as provided in the summary is 7,150,000. That's now for the tangible assets. Okay, then we go back for the non-current assets, property, plant, and equipment in note number 2. Note number 3 is long-term investments. All right, note number 3, long-term investments for investment in equity securities for 250,000 as given, long term 250,000, and cash surrender value of life insurance contract of 50,000. So the total of 300,000 for the long-term investments. Then note number 4 is intangible assets. Actually, in the summary, it's 400,000. However, the intangible assets include a franchise of 100,000, goodwill of 200,000, all right, and discount on bonds payable, but this is not considered as an intangible asset, but is to be deducted from bonds payable. Okay, so we have now your notes number 1, 2, 3, and 4 for the asset section. Total assets of 9,850,000. Now, for the liabilities and equity, we have the current liabilities. We refer to note number 5. Note number 5, for the trade and other payables. Accounts payable 400,000 and taxes payable 150,000. So accounts payable as given of 400,000. Notes payable, we have 400 ang accounts payable. Notes payable, short-term debt 450,000 and long-term of 300,000. Taxes payable of 150,000 and appropriation for contingencies 200,000. So actually our trade and other payables total of 400,000 only, and taxes payable of 150,000. Now these are included in trade and other payables. Still part of the current liabilities is the short-term debt. Notes payable, it's given, it's a debt. In other words, we did not include it in trade and other payables because it's not a trade payable, but it is a short-term debt. So the notes payable short term is still a current liability. Total current liability of 1 million. Then the non-current liabilities as found in note number 6 for bonds payable given of 2 million, and the bonds payable is due in 2023. So we have now your long-term liabilities. Bonds payable due December 31, 2023 for 2 million, discount on bonds payable of 100,000, which was included among the uh, here we have the 100,000 included among your intangible assets. So it has to be appropriately deducted from bonds payable. So the net bonds payable is 1,900,000. To be extended, bonds payable 1,900,000. And the notes payable being a long-term debt, the notes payable being a long-term debt in the amount of 300,000. Given ang short-term 450, the long-term is 300,000. So the total current liabilities 1 million, the non-current is 2.2 million, giving us the total liabilities of 3,200,000. For the share capital, we have notes 7 and 8 for the share capital and for the reserves. Note 7, share capital, preference share capital, 5 pesos stated value, 300,000 shares authorized, 150,000 shares issued. So at 5 ang iyang stated value. So the total stated value of the preference share is 750,000. Now, given in the first part, issued 150,000 multiplied by 5. The ordinary share capital, the par value is 20. Issued is 100 shares, 30 per share. So, ordinary share capital with a 20 peso par value issued 100,000 shares. So, you get 2 million. The total share capital of 2,750,000. For the reserves, we have share premium preference. We have the stated value of 750,000. However, we have included here the share premium preference of 250,000. Stated value is 5. Authorized 300,000 shares, issued 150,000 shares for 1 million. Now that's for 1 million minus stated value of 750,000. That's why we have a share premium, the excess of the selling price over the stated value. Share premium ordinary was for the amount of at 30 per share, but the par per share is only 20. So in other words, there's a premium of 10 multiplied by number of shares issued 100,000. So we have share premium ordinary 1 million. Then we have retained earnings appropriated for contingencies. So the amount given is 200,000. We have now your retained earnings appropriated for contingencies. So we have now the amount of the retained earnings given. We have only your uh, equity of 6,450,000. That's the amount given. However, here we have your share capital, then reserves, and we have the total of 6,650,000. 6,650,000 minus 4,200,000. That's the amount of the share capital and the reserves. So we have the difference of 2,450,000 being the amount for the retained earnings. So, retained earnings added, we now get total equity of 9,850,000 for the total liabilities and equity. Now, with the corresponding notes and computations as with regards to the final amounts. Okay, I will be discussing next 2-4. Again, the requirement is statement of financial position for the following. We have the current assets for cash and cash equivalents. So we have cash and cash equivalents in note number 1. So we have cash in bank for 700,000. And we have money market placement of 500,000. Given money market placement 3 months 500,000, and given is cash in bank of 700,000. So the total of note number 1 is 1.2 million. Next, for note number 2, here, note number 1 is cash and cash equivalents. Note number 2, given is accounts receivable of 800,000 and notes receivable of 200,000. The total is 1 million extended to the statement proper. Now, for trade receivables, and we have note number 2, accounts receivable and notes receivable. In between cash and trade receivables, we have the financial assets at fair value. So the financial assets at fair value are supposed to be a short-term investment of 400,000. Next, we add the inventory, the net amount of 1 million. Inventory is included 1.3 million, and then we deduct 50,000 and 250,000. Inventory account was found to include the cost of office supplies of 50,000 and the office equipment acquired at the end of 2020 at the cost of 250,000. So it's not supposed to be included. These are personal cost on the part of the owner, but not to include the inventory in the books, no, not to include the cost of the office supplies. As supposed to be, this should be segregated as well as the office equipment. Now we have the prepaid expenses. In note number 3, prepaid expenses amounted to the office supplies included in inventory is prepaid expenses. Next, we move to non-current assets. The property, plant, and equipment, 3,950,000, and we have now the breakdown in note number 4. So we have now the matrix for property, plant, and equipment. Land at cost of 1 million. It's the cost of the land. So we have now other assets included land and building acquired in January 1, 2019 for 4 million, less mortgage of 2 million, and accrued interest on the mortgage of 200,000. At the time of purchase, the land was worth 1 million. So we have now the carrying amount of the land. And the purchase price is 4 million here. So the building is 4 million minus 1 million. So it's 3 million. And the building on December 31, 2020, that's the year end of the second year. The remaining life of 18 years. So we have now the building of 3 million. The accumulated depreciation is 300,000. Since the life initially is 20 years, the land and the building were acquired on January 1, 2019. And as stated, the building has a remaining life of 18 years on December 31, 2020. Meaning, the life of the building, the remaining life is 20 years from January 1, 2019. And as of December 31, 2020, its expired life is already 2 years. So dividing 3 million by life of 20,000 supposed to be, that would mean 150,000 for the depreciation per year, and we have 2 years from January 1, 2019 to December 31, 2020. That's why we have the amount of 300,000. The 300,000 is the result of multiplying 150,000 the annual depreciation by 2 years. So 300,000 deducted from 3 million, the carrying amount is 2,700,000. Then the office equipment, the amount of the office equipment is 250,000. Okay? The office equipment of 250,000, there is no depreciation as of the moment. So in other words, as stated in paragraph above, the office equipment acquired at the end of 2020 at a cost of 250,000. So the carrying amount of the property, plant, and equipment is 3,950,000. Now, for liabilities and equity, we have the current liabilities, the trade and other payables. In note number 5, the trade and other payables in note number 5 includes accounts payable of 1.5 million, okay, accounts payable of 1.5 million as we have now the current liabilities of 1.5 million. Withholding tax payable of 100,000. So that's your withholding tax payable. Other liabilities consisted of withholding tax payable in the amount of 100,000. Now stated current liabilities represented balances that were payable at the end of that were payable to trade creditors. So that's why we recorded this as accounts payable. Other liabilities consisted of withholding tax payable na 100,000 as given above. However, no recognition was given to accrued salaries. So we have accounts payable 1.5 million, withholding tax payable 100,000, accrued salaries payable of 250,000, and accrued interest payable of 200,000. The accrued salaries of 250,000 stated. No recognition was given to accrued salaries. Now we have the total of the trade accounts and other payables of 2,050,000. So we have the trade and other payables. Okay? Then for the non-current liability, we have the mortgage payable. The non-current liability, as stated, we have the mortgage payable in the amount of 2 million. So that's the amount given for the non-current liabilities. So how would you account for the non-current liabilities? Mortgage payable is included. Next, equity, the ordinary share capital of 100 par. So the company was organized in 2019 when 30,000 shares were issued with par of 100,000 were issued in exchange for assets with fair value of 3.2 million. So we have now the ordinary share capital at par, 3 million, taken by multiplying 30,000 by 100 par. Then the share premium, 3.2 million minus 3 million nga par. So we have 200,000. And the retained earnings as found in note number 6. The net assets per book is 4,200,000. The contributed capital, that's your 30,000 shares, including the premium. So 3.2 million. The unadjusted retained earnings is 1 million. Then we are going to adjust for the unrecorded salaries, 250,000, the unrecorded salaries, and depreciation on building with an original cost of 3 million as given, and a life of 3 million divided by 20 years. So 3 million divided by 20 years, and we have 2 years expired, so 300,000. The unrecorded depreciation, which we are going to adjust, deduct from the amount of the unadjusted retained earnings of 1 million. So the adjusted retained earnings after the two adjustments. Now the unadjusted retained earnings is 450,000. Okay, so that's all for problems 2, 3, and 4. I again assign to you problem 2-5 up to 2-16. Up to 2-16. Okay? So after this, after 2-16, I will again discuss the next set of problems. We have 2-17. That's the multiple choice problem. 2-17. Okay? So, the letter answer to 2-17 is D. Now, what's the requirement in 2-17? What total amount should be reported as current liabilities on December 31, 2020? We are given accounts payable, short-term borrowings, bonds payable, due 2022. The year now is 2020. Discount on bonds payable, mortgage payable, the current portion, 500,000, and bank loan due June 30, 2021. The 1 million bank loan was refinanced with a 5-year loan on December 31, 2020. Now, that's with regards to the 1 million bank loan. The financial statements were issued on March 1, 2021. So, what amount should be reported as current liabilities in 2017? Accounts payable, 2 million, short-term borrowings, 1.5 million, and we have the mortgage payable, the current portion is 500,000. So the total current liabilities in number 17 is 4 million. So it's letter D. Next, we go to number 18. In number 18, we have two questions to answer. Number 18, question number 1, and question number 2. In question number 1, what amount should be reported as total current liabilities? First, we have the accounts payable of 2.2 million. That's the gross. Because 2 million was after deducting the debit balance of accounts payable. So, usually we do not deduct creditors' accounts with debit balances, but we really have to show each one of this at gross. So we have now the accounts payable of 2.2 million, then followed by accrued expenses 800,000, income tax payable 1.1 million. Then we have the cash dividends payable of 600,000 for total current liabilities of 4.7 million. The problem is asking for the total current liabilities. Now for the accounts payable in the amount of 2 million, add back debit balances. So the adjusted balance of accounts payable is 2.2 million. The creditors' debit balances are not netted against accounts payable but should be reported as current assets. The share dividend payable is part of shareholders' equity as addition to share capital. So we have now the answer to question number 1. It's letter B. For the question is asking for the total of the current liabilities. So the total of the current liabilities. The creditors' debit balances are not netted against accounts payable but should be reported as current asset. The share dividends payable is part of shareholders' equity as an addition to share capital. Now, question number 2, what amount should be reported as total non-current liabilities? So, we have bonds payable, 4 million, 500,000. Then, we add premium on bonds payable, 500,000. We have deferred tax liability for another 500,000. Notes payable in the amount of notes payable 1.5 million due March 1, 2021. That's the currently due portion. And we have now the 8% notes payable is also classified as non-current because the entity has description to refinance. Now, the 6% note payable is classified as non-current because it is refinanced at the end of the reporting period, while the 8% notes payable is classified as non-current because the entity has discretion to refinance. Okay, so in problem 2-18, the answer in question number 1 is B. Question number 2 is C. Now we go to problem 2-19. 2-19. Gold Company provided the following trial balance on June 30, 2020. So we have a cash overdraft. Normally, a cash overdraft is a credit in the cash in bank account. So in lieu of being a debit, it's a credit. So the balance is abnormal, no? Kaya nga credit siya when normally it's a debit. Then we have accounts receivable, inventory, prepaid expenses, land held for sale, property, plant, and equipment, net, accounts payable, 200, accrued expenses, 150, share premium for 250, share capital for 1.5 million, and retained earnings for 800,000. So, checks amounting to 300,000 were written to vendors and recorded on June 30, 2020, resulting in a cash overdraft of 100,000. The checks were mailed on July 9, 2020. Now, normally, problems like this would involve reconciliation statements of the bank and the book. Land held for sale was sold for cash on July 15, 2020. Now that is after the balance sheet date. Question 1. What total amount should be reported as current assets? So we have now question number 1 for problem 2019. Okay? So question number 1, what's the total of the current assets? Current assets includes cash of 200,000. Checks amounting to 300,000 were written to vendors and recorded on June 30, 2020, resulting in a cash overdraft of 100,000. The checks, however, were mailed on July 9, 2020. So in other words, the checks now of 300,000 and we have cash supposed to be because the checks were mailed on July 9, 2020. It now appears that the check was not yet paid for in favor of the company, but the checks were just written off by the company. However, these checks are normally included as part of cash. So 300,000 minus the overdraft of 100,000. Then we record accounts receivable 350,000, inventory of 580,000, prepaid expenses of 120,000, and land classified as held for sale, leading to the total current assets. So, in other words, total here is 2,250,000. It's letter A. Now, question number 2. What total amount should be reported as current liabilities? So, for current liabilities, so by the way, you have your corresponding adjusting entries. For question number 2, your answer is in the form of question number 2 now is asking for the non-current reported as current liabilities. Question 1 is current assets. So in question number 2 now, where the answer is here. C. So how do you know that the amount is supposed to be deducted, no? In question number 1, the 300,000 nga check, but it ended up with an overdraft of 100. So in other words, the net cash is 200,000. Now you involve debit to cash, 300,000 credit to accounts payable. So the adjusted balance is 200,000, 300,000 minus the overdraft of 100,000. So in question number 2, what's the amount to be reported as current liabilities? So we have now the amount to be reported as current liabilities. We have the corresponding accounts payable. Then we have the uh, accrued expenses for the amount of 150,000. But the problem now is asking for current liabilities. So 200,000, we add 150,000, and finally add the amount of 300,000. Now the 300,000 is to be added, and finally we have 650,000. In number 2, the answer is letter C. Accordingly, the adjusted cash balance is 200,000. That's 300,000 minus the overdraft of 100,000. Now, in question number 3, what amount should be reported as shareholders' equity? So, shareholders' equity, we have 1,500,000, the share capital given, and then we add 250,000. That's the share premium. So the total now is 3,200,000. Missing is 100,000. So we have now in question number 3, we begin with share premium, 1.5, share capital, 1.5 million, share premium of 250,000, and add retained earnings of 800,000. So the total of the equity section is 2,250,000. For question in 2019. Okay, see in 2019, after we have finished the straight problems, now we have done the multiple choice problems. Okay, so we have already finished 2019 and as well as 2019 lang, no? So we have 17, 18, and 19. Okay, we go to 2020 again with 2 questions. 1. On December 31, 2020, what total amount should be reported as current assets? And what amount should be reported as total retained earnings? In 2020, we are given the trial balance on December 31, 2020, which had been adjusted except for income tax expense. So we have the amount for cash, accounts receivable net, prepaid taxes, inventory, property, plant, and equipment, accounts payable, share capital, retained earnings, foreign currency translation adjustment, then revenue and expenses. Now for the total debits in 2020 of 50 million, and this same is the credit of 50 million. During 2020, estimated tax payments of 1.5 million were charged to prepaid taxes. The entity has not yet recorded income tax expense. Tax rate is 30%. The accounts receivable included 3 million due from a customer. Special terms granted to this customer require payment in equal semi-annual installments of 500,000 every April and October 1. Now, on December 31, 2020, what amount uh, should be reported as current assets? So let's now take up 2020. Current assets will include cash of 5 million, then accounts receivable 8 million minus 2 million, because the accounts receivable included 3 million due from a customer. Special terms granted to this customer require payment in equal semi-annual installments of 500,000 every April and October. So we have now in accounts receivable, we are deducting from 8 million, only 2 million, because 3 million minus 1 million. So we have 6 million, and the inventory is recorded at 6 million. In the problem, the inventory is 6 million. Okay, it's 6 million. So the total current assets includes cash of 5 million, then include accounts receivable net of 2 million. So you have 8 million. And we have the inventory as given 6 million, and total current assets of 7 we have 17 million. Now for answer to question number 2, the question is, what amount should be reported as total retained earnings? So the income before tax is 5 million. That's the income before tax. 15 million revenue minus 10 million expenses. So the income before tax is 5 million. We deduct the tax at 30%. That's the tax rate. So 5 million minus 1.5 million. Net income after tax of 3.5 million. Then we add retained earnings on January 1, giving 5 million. The total of 8.5 million. We are supposed to have the retained earnings on January 1 equal to the given amount in the problem of 5 million. So total is 8.5 million. That's for problem 2-20. 2-21 has 4 questions. 2-21 has 4 questions. It's quite a long problem. 2-21, total retained earnings, non-current liabilities, total current assets, and shareholders' equity. So in Problem 2-21, question number 1. How about the total of the retained earnings? Here we are given the earnings from a long-term contract of 6,680,000 involving cost of 5,180,000. So the income before income tax of 1.5 million, we deduct the income tax of 4.5 million and deduct 30%. That's 450,000, giving us net income of 1,050,000. We have the retained earnings unappropriated. Then we have the retained earnings unappropriated here of 900,000. We add it to net income, no? So, ang aton nga net income, 1,050,000. We add the retained earnings unappropriated of 900,000 and the retained earnings restricted of 160,000. So, the total retained earnings of 2.11. So, 2,110,000, giving us letter B. Next question, in this same number, we have now question number 2. The total of the non-current liabilities. So, notes payable is non-current. It's 1,620,000. The billings in excess of cost on long-term contracts account is a current liability. PAS 11 requires that an entity shall present the gross amount due from customers for contract work as an asset and the gross amount due to customers for contract work as a liability. So we have now question number 2, the total of the non-current liabilities. So the answer is 1,620,000. It's letter A. Question number 3, total current assets. So we have cash of 600,000, accounts receivable 3.5 million, cost in excess of billings for 1,600,000. The total is total current assets 5,700,000. Okay, so the answer is letter C. Next, we have question number 4. Total shareholders' equity. In question 4, requirement 1, we have now the share capital for 2,030,000 given 2,030,000. Then we have 2,030,000, okay, for the given shareholders equity. We are now in number 4. Share capital 750,000, it's given. Share premium 2,030,000 and retained earnings of 2,110,000. That's now your retained earnings in requirement number 1. Next problem, we have 2-22. Show company provided the following trial balance on December 31, 2020, which had been adjusted except for income tax expense. So, how much total current assets in number 22? Cash, accounts receivable, inventory. So, cash, 600,000, accounts receivable for 2,800,000. Here, we have 2,300,000. Accounts receivable initially at 2,800,000, but the accounts receivable included 1 million due from customer and payable in quarterly installments of 125,000. The last payment is due on December 30, 2022. So we have now the amount of the accounts receivable of 125,000 per quarter multiplied by 4 quarters in a year. So it's 500,000. Therefore, 2,800,000 minus 300,000 ay minus 500,000. 2,800,000 the given amount. We deduct 500,000. So the difference is accounts receivable of 2,300,000. Now, because there are quarterly payments which are made. During the year, estimated tax payment of 600,000 was charged to income tax expense. The income tax rate is 30%. So, how much total current assets? We have cash, accounts receivable, inventory is only 2 million, total current assets 4.9 million. Accounts receivable of 2.8 million, but we deduct due in 1 year of 500,000. The adjusted current portion of 203 or 2.3 million. Total current assets of 4.9 million. In question number 2, the total current liabilities. Accounts payable and accrued liabilities 1.8 million, and the income tax payable of 1.5 million. However, we have 600,000 charged to income tax expense. So we are deducting 600,000, giving us 900,000. Then deduct from accounts payable and accrued expense. So we have difference of 2,700,000. That's in question number 2. Question number 3, how about the retained earnings? So net sales and other revenue given is 15 million. We deduct cost of 10 million. We now end up with income before income tax of 5 million. Then we deduct further. We are deducting retained earnings. So, in question number 3, the answer is letter C. Alright, we have all these problems in theory, no? So, I will just continue with the letter answers. Here we have to begin with 2-23. Oh, it's still a straight or a multiple choice problem. So in 2023, the answer is D for the total current liabilities. So for the total of the current liabilities. Alright? So we now get the answer to number 23 as D as in dog. Number 24 is A. So you now have the letter answers to 25, 26, and 27. Now we have all of this with letter answers up to number 29. So will you get the letter answers now from numbers 25 to 25? The answers are number 1 C, number 2 A, 3 and 4 dog, 5 and 6 7 A, 5 6 7 8 A, 9 dog, 10 C. 2-26, number 1 dog, number 2A, 3C, 4 dog, 5A, 6C, 7A, 8, 9, 10 dog. 27, number 1A, number 2 dog, 3 boy, 4 dog, 5 dog, 6 boy, 7 dog, 8 dog, 9 dog, 10 C. Number 28, number 1A, number 2 dog, 3C, 4 dog, 5B. And 29, number 1A, number 2 dog, 3 boy, 4 dog, 5A. Okay, that's enough. We have finished up to number 29. So on Thursday, we are going to tackle the remaining problems which I have assigned to you, 2-1 and 2-5, and the multiple choice problems 2-6 up to 16. Okay? So, thank you for your cooperation, and see you on Thursday. I'm giving an exercise, no? On Thursday before we begin with our discussions. Okay, convert.